Hello, everybody. It is Tuesday at 6 p.m., which means it's time for Office Hours. And I'm your host, Bill, founder, chief tax strategist here at Tax Sherpa. And I'm flying solo tonight. I wanted to go over a couple things that I made a quick video about last week. I'm not even sure if the team got it out yet. But yeah, there's a lot of complicated stuff going on. And somebody had a really good question about how it all works. So I wanted to do a little bit of a deep dive today into cost segregation and to walk through how that all works. But before I do that, let's go ahead and make sure everything is actually working. So let's see what Restream says. Restream says we're live, which is great. And I'm just going to assume the internet works. Let's see you on YouTube. How about that? I press play. Yes, so it is working. Great. I'm gonna do a little bit of a hot swap here because it does take a little bit of figuring to get everything working here. So let's see. Let's go to your studio mode. Let's do that. Let's do that. And let's transition. Alrighty. Here we are. It is office hours. It is Tuesday at 6 p.m. All that jazz. And let's move this over because everything's set up for having two people on the stream. But yeah, we do this every week. We answer questions. And this is going to be one big episode about one question and the different pieces that comes in with. Let's do a little bit about my story here. I'll give you the quick version, the quick and dirty version, as I like to say. Back in 2000, I realized that the corporate world was not going to be for me. And there was actually a specific moment that happened where somebody got an award at the company I was working at. They got an award for canceling their vacation to Europe with their family that was already approved and already paid for. And it was a 2-week vacation. They came into work instead. And isn't he such a great company man? Let's give him a hand. He is a celebrated guy. He was like, oh, I got Serena coming in here. Let's do that. Let's bring her in. And so I realized at that moment, that was not what I actually wanted. Let's bring Serena in here. Hey, Serena. Hey. There she is. So I thought I was blind solo, but I guess not.
Nope. Not
Trapped in meetings, I understand. So I realized then that corporate ring is not for me. And I started my own entrepreneurial journey. And then in 2007, I started getting nasty letters from the IRS. Like I owed them over $1 million. It was over $1.3 million, actually. And like most people, I ignored those for a while. And by 2009, they started garnishing my paycheck. I was like, oh, okay, I got to fix my problem. So in doing that, I fell into the Wall Street tax world. And over the last 15 years, I've worked on 50,000 plus tax returns on billions of dollars worth of client earnings and saved clients. If we added everything up, it's in the hundreds of millions of dollars at this point, which for me is fantastic because part of my mission is to defund the government. But in 2019 and really started getting going in 2020, I went off on my own and founded Tax Sherpa here to serve those people like me, the solopreneurs, the independent contractors, the small business owners, to help them keep more of their cash. And there's a very core reason why that's so important. Because first, we got to ask the right questions because the quality of our questions determines the quality of our life. So my question became, what is the root problem with overpaying on your taxes? Because to be perfectly honest, it's an option. You can overpay if you want to. I don't recommend it, but you can. I've talked to people, various clients over the years, and they have been entitled to different deductions and things, and they've opted not to take them just because it made them uncomfortable to get such an advantageous position with the IRS. It's a mistake, but you got to sleep at night. But to me, the real problem there is that you're wasting 20% of your life. And that translates to 74 days a year. Because a day that you go to work, you do your thing, you earn money, you come home and you take that money and hand it over to the government in the form of taxes. That's a day that you didn't work for yourself. It's a day you didn't work for your family. It's a day you didn't work to build your business. It's a day you didn't work to improve your community. That's just a wasted day, as far as I'm concerned. So with that, so Serena, before you jumped on this, I was telling everybody that I'm going to be going over some cost segregation stuff. But don't worry, I have the answer to all tax questions that might be percolating in their minds. And the answer is, Serena, what's the answer?
It depends.
Depends on the facts and circumstances. And we're going to deep dive into that a little bit tonight when it comes to cost segregation. Maybe if there's time at the end, we'll get to other questions. But that is the basic idea. Let's get out of here. Let me get into this little chart that I made. When is cost segregation useful? So first, before we get into when is it useful, let's talk about what it actually is. So cost segregation is the idea that you can separate costs into different groups. And that sounds obvious, but what it applies to is real estate investors. So when you have rental real estate, investment real estate, you have your rental income and you have your cash expenses. And then if you have a mortgage, you'll have interest expense on top of that. And those are going to be your deductions against that rental income. And hopefully, if you bought right and are managing your property well, you end up with a net profit on a cash basis. So that's all great. We don't want to pay taxes. If we have net profit, that means that's increasing our income. That means increasing taxes. So how do we turn that around and turn it into decreasing our income and decreasing our taxes? And that's where depreciation comes in. So depreciation is an allowance that is made for the wear and tear on an asset. And for real estate, that means building wears out over time. And that's absolutely true. Anybody who owns any property, whether it's their primary home or whether it's investment property, you know that there's maintenance all the time, right? Things fall apart over time. The only part that doesn't fall apart, that doesn't depreciate, is the land. And the land can go up and down in value, but it's not depreciated because it's just land. Where I am right now, I live on a 1/4 acre suburban lot. There's a house on it, there's a driveway, and the land remains the same, even though the things built onto the land change. Land is not depreciable, but everything else is. For real estate, the government has come up with these depreciable lives. And for residential real estate, it's 27.5 years. For commercial real estate, it's 39 years. For foreign real estate, it's 40 years, which we don't see too much of, but every now and then. So 27.5 years, that's the most common number that people run into. And roundabout, if you bought a piece of property and you divide it into 27.5 segments, each segment is going to be about 4%. I'm rounding, but that's basically it. So, you get to write off as a depreciation expense 4% each year. Just to put some numbers to the example, let's say you bought a property for $500,000. 100,000 is land, 400,000 is building. So then we could depreciate that 400,000 over 27.5 years. And that translates to, let's see, bring up my calculator here. 400,000 divided by 27 points. That's a $14,545 deduction that you get to account for that depreciation, that wear and tear you get every year. Let's say before depreciation, your net income on a cash basis was $5,000. We subtract 14,545 from the 5,000, and we end up with a loss, 9,545. So then, depending on your tax situation, that might be deductible. That might be deductible against your other income. And by creating that tax loss, even though it's a cash flow profit, that's where real estate really shines as an asset class when it comes to taxes. And people will talk, if you go on TikTok and YouTube and whatever, people talk about the tax benefits of real estate. This is what they're talking about. So the depreciation allows you to shelter cash income and not pay taxes on, which is fantastic. But there's problems with that. So problem number one is that the depreciation is helpful, but it's not enormous. So that's issue number one. Issue number two with real estate is that by default, it's considered passive. And if you have passive losses, which would be generated by the real estate, then you have limitations on that. So if your income overall is under 100,000 for the year, then your passive activity loss limit is $25,000, which is significant. If you have a couple properties, you can reach that without too much trouble. As you make more money, though, your limit reduces. And by the time you get to $150,000, your limit is zero, meaning that if you earn more than 150K, then no matter how much losses you have in your passive rentals, those losses do not count in the current year. They get carried forward into the next year, to the next year, to the next year, until either your income is low enough to take those losses or until you sell the property. And if you sell the property and you have carry forward losses, that just reduces the amount of gain that you have. from that transaction. So those are issues. Those are fixable issues, though. So if you are able to convert that activity into an active activity, not a passive, then you are able to take those losses without limit against your other income. So this is a really powerful strategy when it comes to like short-term rentals. If you have rentals where the average stay is less than 7 days, you're not considered to be in the rental business. You're in the hospitality business. It's like you're running a hotel effectively. So that's one way to get active and get out of those passive limits. Another way is there's 3 different hourly tests that you might be able to satisfy. And there's some figuring to do with these hourly tests. Sometimes if one spouse is working and the other is not, we can put the other spouse that's not working into the real estate business. And so there's 3 tests. The one that everybody hears about is the real estate professional test. And that is where you spend 750 hours or more during the year and 50% of your working time or more during the year on real estate activities. This one is the most flexible and it qualifies you as a real estate professional. So it's the most flexible in that you can have real estate activities that are not related to your rental portfolio. So if you're a realtor or a mortgage broker or someone who works in construction and you work for yourself in all those things, you're an independent contractor or own your own business doing those things, then you can begin to qualify under that 750-hour test. The other 2 tests are specifically related to dealing with the property. So they're a little bit more restricted. The first is a 100-hour test. 100 is way easier to get to than 750. But the catch with the 100-hour test is that you have to be the person who spends the single individual who spends the most amount of time on this property. Like we were talking to somebody last week and they spent 70 grand on some renovations because they had water damage and it was the whole thing. And the people doing those repairs were spending more time on that property than the owners were. So they couldn't satisfy that 100-hour test. The next test, though, is a 500-hour test. And the 500-hour test is, there's no having to be the person spending the most time. It's just that you spend 500 hours, you're materially participating, that income becomes active income rather than passive income, right? And you can escape the passive activity loss limitations. So that's all the backdrop where if you are able to take large amounts of depreciation or large amounts of expenses and make them useful, then cost segregation starts to come into play. What cost segregation is taking that structure, that 27.5-year structure, and breaking it into its different components. And depending on the size and scope of the property, sometimes there are online tools you can use to do this kind of work. And sometimes you have to actually hire an engineering team to come out and examine your property and give you a report. But basically, there's different lifetimes of property. There's 5-year property, there's 7-year property, there's 15-year property. And then there's the real estate itself, 27, 39, and 40-year property. So by segregating, that's where the cost segregation term comes in, by segregating the cost basis that you have in the property into these different categories, we're able to capture a lot more depreciation in the early years than in the later years. So the total is still the same, but we're just shifting categories. And with bonus depreciation, we're able to capture basically 60% of that new category in year 1. So just to put numbers to this, we have that $400,000 property that we were talking about, or that it was 500, but 400 was depreciable. So let's go to calculator. So we have 400,000. And if we divide by 27.5, we get our 14,545. Now, if we instead do cost segregation, the numbers are going to vary depending on the property. But basically, a lot of times you'll see, except the right numbers here, 400, 2, 3. A lot of times we'll see the property being about 15% being separated into the shorter term asset classes. So if we take 15%, that's going to be 60,000. So now we've got 60,000 in shorter term property and 340,000 in longer term property. So on the 60,000, we're going to get roughly 60% of the deduction in year 1. So times 46. So that's $36,000. Let's keep that in mind, $36,000. And now we have the remaining 340,000 divided by 27.5. That's 12,363. So our long-term depreciation was decreased from 14.5 to 12.3, but we got 36,000 in year 1. And so our year one depreciation is $48,000. Okay. So I know that was a lot of math, but bear with me. So by doing cost segregation, then we changed the year one depreciation from 14.5 to 48.3. So if we do the difference there, that's increasing by $33,000 because we gained the 36 and we lost a little on the long term. So 33.8. So if you're in a high tax bracket and you're able to capture that difference, now we're talking about savings, whatever your marginal tax bracket is on 33,800. And let's say you're in the 32% bracket with 5% state. So you're at 37% altogether. That's 12,500 added to your pocket in tax savings by doing this strategy. Before people get too excited, before you go looking at all the TikTok videos, there are steps to make sure that this is actually useful. And this is what this chart is trying to show here. This is a chart actually made for our team internally. And it's a bunch of yes, no questions. And the core question is cost segregation useful? So question number one, is there a tax liability? Because if no, cost segregation is not useful. So we've had people come in with cost segregation reports and they're all excited. They're like, look at this. I got so much tax savings. It's not doing anything for you. You didn't owe anything in the first place. Great. You have the report. Yes, it'll carry forward. And when it's useful, it will be useful, but it's not right now. Whatever you spent on that report is probably not the most efficient use of money. But let's say we do have a tax liability. Do you have a long-term rental property? If no, do you have short-term rental property? So if you have short-term and you have a tax liability, then yes, cost segregation is going to be useful. If you don't have long-term and you don't have short-term, then you don't have rental property. Cost segregation is not useful. All right, but let's say we do have long-term rental. Now we have to ask ourselves whether we can qualify for one of these hourly tests. So if you can be a 750-hour real estate professional, then yeah, cost segregation is useful. If you fail that, can we qualify as active or material with a 500-hour test? Yes, but then cost segregation is useful. If we fail that, can we do the 100-hour test where we have 100 hours and single individual spending most time on the property? Yes. If yes, cost segregation is useful. If you fail all of those, there are a couple other tests, but they're not used very much. They're the most useful of the ones we don't cover here is that if you're materially participating in, I think it's 5 out of the last 10 years, then you can also qualify this year, even though you don't meet the hourly standards. So there's a little bit more digging to do there. But basically, if you fail all those tests, then you're going to be passive and cost segregation is not useful. So that's how we figure out whether or not to do a cost segregation study and to apply these strategies or not. And then with that background, we had a client ask, where is that on the tax return? Because there's no section or line item or anything that says cost segregation on a tax return. What happens is that the assets that are being depreciated change. And that's going to flow through if you're doing Schedule E for 1040, which is where if you individually own or through a disregarded entity own some real estate, then line 18 there is depreciation. And that number just goes way, way up. And you can attach depreciation schedules itemizing the different assets for 5-year, 7-year, and 15-year. So the driveway and landscaping, that's going to be like 15-year property. The cabinetry is going to be 5-year property, things like that. So we can detail all those things out. And so there's no one item on the tax return that says cost segregation. It's just a result that happens from doing cost segregation to increase depreciation expenses. That's how it flows through. And if it applies, it's a super powerful strategy. Make sure to think about it if you have rental real estate. Another thing to keep in mind is that when it comes to these hourly tests, if you have more than one property, there's an election that you have to make on your tax return to treat all real estate activities as a single entity for qualification purposes. I don't remember the code section of the election, but it's got to be done on an original return. You cannot make the election on amendment, which is interesting. A lot of elections you can make on amendment, but on this one you can't. So you have to go into it knowing that, again, if you got 2, 3, 4, however many properties, and I'm keeping my logs of my hours, and that's something you have to do. You have to keep what they call contemporaneous logs, meaning you got to do it as it occurs. And so we have a log template that we give to clients and it allows them to list out the different properties, and then they can make an entry for each thing that they do for each property, and then it will automatically summarize everything on the end of it, so that we can determine which test they might qualify for. Yeah, it's a lot of work, but it can be super, super powerful if it applies to you. You want to go through this matrix or this flowchart to make sure that it does apply to you before going down the path of doing all this work, because it's a lot. There are expenses involved. You got to pay these engineering firms to generate these reports, because if you do it without that and you get audited, you will lose. But if you do that with a report and say, here's how I came up with these numbers, they say, okay, and they'll accept it. One quick story about active versus passive. This is the kind of thing that can get audited. If you have high income and you're taking massive losses on the real estate side, occasionally they'll question it. We'll say, hey, show us how you are materially participating or how you're professional or whatever, which means give us your logs. That's the IRS speak. So we had one client, this was several years ago, who had a short-term rental and average stay was under 7 days and had gotten audited. And it was a whole issue with they had a PO box that they didn't check. So the IRS said you took too much time. There's all back and forth thing. But it ended up being a $50,000 question. And I was talking to the clients and I said, okay, here's what we were doing. It's going to be a bit of a fight, but you will win in the end because you are right. And they said, yeah, it's actually not worth the 50K because their other business was taking off. And with the time it would take to give attention to this thing, it'll cost us more than 50K on this other side. And they ended up making $2 million in their other business that they had just started. So that was a correct decision. But it is the kind of thing that you want to make sure you have all your ducks in a row on, because the IRS will occasionally ask about it. Got to prove your laws, prove that you're material or you're professional or your average stay is under 7 days, and you've been willing to back that up. And then obviously you need the cost segregation report itself in order to back up the calculations of all those different expenses. So that is, in a nutshell, how cost segregation works and some of the issues with it. But like I said, if it applies, super powerful, really great strategy. And I actually did that faster than I thought it would. We're only half hour in. With that, let's go back to the actual Q&A stuff.
Neal, they are really fast. The cost seg reports, that's something that we do for clients, right? We can provide them the cost seg report if they need it. It's okay. But I don't have to go nowhere else and get it.
Sometimes we'll bring their own, and sometimes they'll ask us to get it around. We can do it either way. Serena, what do we have on the list this week?
Alrighty. So we have a question here. A question states, how can I give money to my family members without paying taxes?
You're out of check. But yeah, people worry about gift taxes. What happens is that anybody can give a gift of up to, I think this year, 17,000. It changes a little bit every year. I think this year, 17,000.
It's 17.
Okay, great. Pretty look stuff up ahead of that. So anybody can give anybody a gift of up to $17,000 cash and not have to file any reports or anything. If you go beyond that, then you have to file a gift tax return, which means that you get a lifetime exclusion amount to give to people. And if you've heard of the estate tax or the death tax, this is where this comes in. So round numbers, right now we're at about $11 million. That is set to decrease after the Tax Cut and Jobs Act expires in 2026, back down to 5.5 or 6. But if you go above the 17,000, then you start filing paperwork, say, I'm using up my lifetime exclusion. And so if I gave somebody $50,000, let's say, then I would have to file a return and say that I used 50,000 of my lifetime amount for this purpose. And as long as you're below that lifetime limit, you still don't owe any taxes, but you do it to file for. So depending on the situation, that might be worth doing, or it might be worth looking at some strategies. So where this comes up a lot is with grandparents. Usually they're in obviously as a kid, you're growing up. As a parent, you are trying to accumulate your nest egg. And then in your elderly years, a lot of times you're giving that money away, mostly to family members, but it could be charitable causes or whatever. So if it's not a charity, because that's a different reporting mechanism, but if it's to just an individual or a company or whatever that you want to give a gift to, you want to, a lot of people will play with that $17,000 annual limit a lot, because so if you're a married couple, it's individual to individual. So let's say you have 3 kids and 4 grandkids. So the grandpa can give 17,000 to each of the 3 kids, and he can give 17,000 to each of the 4 grandkids. So that's 7. And then grandma can give 17,000 to each of the 3 kids and each of the 4 grandkids. So that's 14 times 17,000 right there. So that comes out to math life, so it's dangerous. That's $238,000 in that scenario that you could give away and not have to report it done. Doesn't get reported against the lifetime exclusion. If you want to go above that, then yeah, start filing. We don't see that too much, but if you're giving away houses and things, then that starts to exceed that 17,000. But if it's cash, usually you can work within those limits and make a strategy work. Also, there are alternative methods of using trusts and things like that, but that's way beyond the scope of what we're talking about here. We're just talking catch this. But yeah, that's the basic idea. So if you end up going beyond your lifetime exclusion limit, then you get into the death tax or the estate tax or whatever, which is one of those taxes that's really a social engineering play because it's a really high tax. It's going to be upwards of 50%. And it's all the amounts above that exclusion. If you make $100 million and your lifetime exclusion is 11, then your estate is going to be paying tax on the 89 million that's over and above that. So nobody wants to do that because I didn't work my whole life and build this wealth in order to just hand it over to the government. That's most people who are in that category feel that way. There's a whole army out there of lawyers and accountants and everything that have strategies to avoid the whole thing. And this is where trusts and charities and all these special vehicles are created in order to make the person who passes away actually have a net worth that's below the estate limit. And if you want to do that, if that's an issue for you, then definitely hire professional help. It will cost a lot, but it will save your estate giant amounts of money. So definitely worth doing. Or don't and have your state hand over a giant amount of money to the federal government. And different states have estate taxes as well. But yeah, I say it's a simple engineering thing because if you look at the charts by the IRS, almost nobody uses it. It's a very small portion of governmental revenue, but it's just there as a stake, basically. So you better get your financial planning in order or else. It's a tax that does nothing except for employ lawyers and accountants. That's the summarized version.
Neal, for real estate taxes, we have a question about a 1031 exchange. They want to know, what is the 1031 exchange and how does this affect my taxes if I decide to do it?
What it is a like-kind exchange. Prior to the Tax Cut and Jobs Act, this applied to a variety of business assets, but part of the language changes was that since Tax Cut and Jobs Act in 2017, it only applies to real estate. And to be determined whether that will go back to other more varied assets after Tax Cut and Jobs Act expires. But for now, just real estate. And what it is saying that I'm exchanging two things of like kind. And I have this investment property over here. I'm going to sell it. I'm not going to take the money and use it for myself. I'm going to reinvest that money into another property that is a like kind. It's also an investment property. And if I do that and I roll over all the funds, then I don't pay any tax on that transaction. So that's the main selling point. Sell a property and I don't pay taxes on it because I have reinvested it into a similar type of asset. And basically, pretty much any real estate, any investment real estate to any investment real estate works. It can't be any real estate that you live in. It's got to be investment property, but you can do like single family to multifamily or residential to commercial. It all works. The key thing is just you keep the money working in the economy. So the caveats with the 1031 exchange was, fantastic. Caveat is that your basis carries over. What that means is, let's say I bought a single family house we were talking about $500,000 before. So, okay, great. Bought it for 500. It appreciates. We've seen crazy appreciation in the past couple of years, and now it's worth 750. So normally that would be a $250,000 gain. Now I take that 750,000 and I put it down on a larger property that's worth 2 million. Say. So now my cost basis on this new property is not $2 million. It's the 500 I paid for the thing that I exchanged. As this process goes on and people use the 1031 exchange more and more, basically the value of the newly acquired property becomes entirely taxable. And so if and when they decide to sell those properties, they have huge tax gains to deal with at that point. So that is I don't know about downside, but it is a consequence of the 1031 strategy. So The overall strategy is the buy, borrow, die method, which is funny to me, but very accurate. So if you want to build a real estate portfolio, and this is all, not maybe not the main, but a primary way of building wealth for my estate. You buy property, you borrow against it, and you get a mortgage, and then you never sell. That doesn't mean you keep the same asset, but you can use the 1031 to exchange into larger and larger portfolios of real estate. And if you're buying smart, then you're kicking off cash flow. And as you grow in equity, you're able to finance out that cash by borrowing against those assets. And then you never sell. At least you never sell in a taxable way. So you keep doing the 10 over and over and over again, because if you do sell, then you would die taxable. So you keep doing that and then you die. So the buy, borrow, die strategy. And then if you're underneath the estate limits, then you don't have to worry about the estate tax. If you're over the estate limits, then you hire the lawyers and accountants like we were talking about before and implement strategies to protect as much of that as possible. That is the way to deal with it. And it's a tried and true strategy. Now, I will say that it is under attack. So the 2025 budget that the Biden administration put out back in March, and now Harris is endorsing, as it's hard to pin her down as far as what her actual plans are, but she seems to be in favor of it. They wanted to limit, in that budget proposal, they wanted to limit the 1031 exchange in two ways. One, they wanted to limit it to one transaction a year. So if you had multiple properties that you wanted to sell, you'd have to space it out over multiple years. And they wanted to limit it to $500,000. So of tax exclusion, gain exclusion. So if you had a property that appreciated by 2 million, then even if you did reinvest the money, you'd still have to pick up the tax of the 1.5 above the 500,000. So those obviously are not laws yet, but it's on the list of things that are under attack. I will say one other thing about that is that I've also talked about eliminating the step up in basis. And this applies to real estate. It also applies to stocks and portfolios and things like that, where when somebody passes away, let's say the estate tax is not a consideration because it's not for most people. Somebody passes away, they leave their assets to their heirs. And under the current law is that the heir, the inheritor, gets a step up in basis, meaning that if I inherit a house from my grandparents or whatever, then it's as though I paid market value on the day I inherit it as my cost base, even though I shelled out zero. So if I then turn around and sell it immediately, which a lot of people do, I have no gain because I bought and sold it quickly thereafter. There wasn't enough time for the real estate to appreciate or depreciate, really. So I end up with no taxable gain and I end up with a whole bunch of money in my pocket. Or if I want to keep the property, then I just keep it. And if I sell it later, whatever the difference between the value when I inherited and the value when I sell, that's my tax. So they want to, or of that same 2025 budget proposal, they wanted to eliminate the step up in basis. You can make arguments for and against. The major problem I have with this whole approach is that this is the major way that wealth is transferred amongst the middle class. It's the real estate that grandma bought 50 years ago for $5,000 and it's now worth $400,000 or whatever the numbers are. But, passing these assets down through the family is the primary method by which people are able to accumulate wealth in their families. And so if they get rid of that, that's going to be a major shift. Because in non-middle class, so on the low end, they don't have the assets to pass down. On the high end, the assets are not the significant portion of the estate. It only really hurts the middle class if that kind of proposal were to go through. I'm against that one. But yeah, it was all tied in with the 1031 stuff and the whole approach as far as how the government is going to be treating it going into the future. So obviously none of that is passed. There's an election between here and there. Even after an election, a law would need to be passed in order to get these changes done. But just be aware, have it on your radar.
Alrighty. Neal, if you had to run for president, what would be some of the tax laws you would change or make better? Have you thought about that one?
I have not thought. If I were king for a day, I could just wave a wand and change all tax law. I would get rid of the corporate income tax altogether. It raises virtually no money, or not no money, but it's 1/6 of the individual income tax. Most tax that is raised by the government is raised from individual income taxes. I would get rid of the debt tax entirely. And then there is this principle that basically the tax revenue collected by the government It varies depending on laws, everything, and economic conditions, but basically it floats between 15 and 20% GDP. And this is true going back 70 years, and it's true in wartime and in peacetime, economic booms and in recessions and all this kind of stuff. Fiddling with the rates and everything doesn't really matter. If we assume that we're going to have a tax system at all, because option A is get rid of all taxes, and you can replace that with fees, which is how the government used to be funded, with import tariffs and duties and then fees for furnace, basically. But we had a very different government back then. So I don't see that working terribly well under the current system. But if we assume that there are going to be some kind of tax system, it would be 100% on the individual side. And then we would probably have a flatter tax. And I'd probably get rid of Social Security and Medicare as a tax. You can keep the programs, but just having the separate regressive tax on wage income just doesn't make any sense. So I would get rid of that. And yeah, it would be a much, much simpler overall approach so that there's a certain amount to be raised. We can target a percentage of GDP and then let's just assess a tax based on that. There's an argument that a lot of people make, the progressive economists, that you want a steeply graduated tax, meaning that the more you make, the more percentage you pay, and aggressively. So like our current tax brackets are first one is 0, but then 10%, 12%, jumps to 22%, 24%, jumps to 32%, 35, 37. So that's a weird distribution. That's intentional. I would make that narrower and get rid of the superfluous things and just make the whole thing much, much simpler. So if I had a magic wand, that's where.
Yeah.
And
Neal for president.
so one on the topic, I would also restrict government spending to last year's taxes raised. That would never fly. That's how we do it.
I'm laughing. I'm thinking in my head, Neal for president. Let's go, everybody. Vote.
I don't think of that. But you feel free to write in my name in November.
Sounds awesome. That's so funny. We have a retirement question, Neal. They want to know if they withdraw from their retirement, is that going to be taxed?
Depends on what kind of withdrawal it is. So I did a podcast with Remnant Finance a couple weeks ago, and they are IBC, an infinite banking concept. So that is using a whole life insurance policy to build up. And the way those work is that your contributions to it are post-tax, meaning you don't get a tax deduction for the money. But what it does is it builds up a value internally. And in retirement, you take loans against that value. Again, this is the buy, borrow, die strategy. And those loans are not income because they're loans. And then when you die, your life insurance pays off the loans and the remainder goes to your heirs. So that's not taxable. If you engage in a Roth retirement plan where, again, post-tax contributions, you don't get any benefits in the year you put in the money. But then on the backside, when you withdraw the money, it's tax-free because you paid the tax up front. The ones where you do have to pay tax is what we call traditional plans, traditional IRA, traditional 401. And there you do get a deduction in the current year for the amount that you put in. And the deal is, in exchange for that tax break you get now, on the back end, when you pull the money out, you pay taxes then. Then there's Social Security income can be up to 85% taxable, depending on how much income you have for the year. Then it's a sliding scale. The more income you make, the higher percentage of your Social Security income that you are taxed on, up to 85%. One of the things Trump was talking about a couple weeks ago was getting rid of that for retirees who are collecting benefits. And I actually made a video on that, how the media was freaking out about this proposal, how it's going to bankrupt Social Security. And well, Social Security is going bankrupt anyway, but it will accelerate the bankruptcy by about half the year. People were talking about 3 years or something, which was just nuts. So yeah, there are, depending on the source of the retirement funds, some are taxable, some are not. Some are partially taxed. So it just depends on how you have it all set up and what you've done in the past to create that retirement income. And also, if you just have regular taxable accounts, like I just have a brokerage account and I've built up wealth in there for my eventual retirement, that's just regular taxable income if you have capital gains or dividends or whatever. All depends.
Oh, it depends. Awesome. So we have a small business question. They want to know, how do I calculate and pay quarterly estimated taxes as a freelancer?
Is it too cheeky to say it depends?
Yeah. No, it's not.
So there's a couple different methods. Method number one is the safe harbor method, where you take last year's total tax bill, add 10%, you pay that in, and that'll cover you for penalty purposes. The number might not be right, but you've paid in at least enough to cover you for estimation purposes. So the benefit of that strategy is that it's simple. You just take the number from your in this case, 2023 tax return, and you multiply by 110%, divide by 4, that's your quarterly estimate. The other method is to actually calculate your your current year estimated tax liability. And that means having to do projections. And so the difficulty with projections is that IRS quarters are not normal quarters. So the payment dates for individual estimated quarterly payments is April 15th, which covers January through March, June 16th, which covers April, May, September 15th, which covers which covers June, July, August, and then January 15th, which covers September, October, November, December. It goes 3 months, 2 months, 3 months, 4 months, as far as what the quarterly estimates are covering. And so what you have to do is you have to do projections out based on each of those timeframes. So that can get complicated, and it's depending on your particular business. Maybe those projections are relatively accurate, and maybe they aren't. Small business, the nature of it is that it's very volatile. There's up years and down years, and there's up quarters and down quarters. It really depends on your individual business. But the advantage of doing that is that you hone in by the end of the year on the real number, and you're not going to have another payment in April. So that's the goal. You want to be paid up by January so that by April, you just keep filing and you're even Steven the IRS. That's the goal anyway, but it depends on how good your numbers are and if you are keeping up to date with your records, all these kinds of things. So those are the two strategies. And personally, I prefer doing the one that is accurate to the current year, but it is more work. But if last year was a down year, this year is an up year, and then I calculate my quarterlies based on the down year before, I could be compliant for avoiding the underpayment penalty based on my last year's income. But then I still have a huge tax bill in it, which is not a situation you really want to deal with if you're making quarterly estimates. So the general approach is going to be, one, minimize your taxes as much as possible. And that's going to deal with entity structure and new tax strategies, all those kinds of things that we do here at Tax Sherpa. And then two, going into all that, decide which way you want to go. And then three, keep up to date with your records. And really that means doing your books. So if you haven't been doing your books a lot, because a lot of solo people don't, or small business people don't, go to our quick and dirty bookkeeping system where you can keep up with your books in 5 minutes a month. It's powered by AI to do the heavy lifting for you. But yeah, use the tools that we have here at Tax Sherpa. We've got the Trailblazer Toolkit, which will do those projections for you month by month. Or worst case scenario, don't do your estimated payments and pay the penalty on the back end. Now, I will tell you, there are a lot of people out there who make a business case for using that approach. You're not supposed to do it. The IRS does not like it, and they will charge you a penalty for it, which is going to depend on the interest rate. So right now it's about 8%. A lot of people make the conscious decision that, okay, if I owe, pick a number, $20,000, I could pay $5,000 a quarter, or I could hold on to the 20 and then pay 21.5 in a year. And is that worth it? Yes or no? You have to make your own decisions enough there. But I will tell you, they will charge you the penalty for doing so. So that's the incentive to keep up to date with your quarter. And okay, I'll say strategy number 4. Strategy number 4 is my favorite. So if you are an S corporation, then, which we generally recommend, like 92% of the time, then you are required to pay yourself reasonable compensation. And that means a W-2. You give yourself a paycheck that has payroll taxes withheld. If you pay your estimated payments through your W-2, they automatically get spread evenly throughout the year, whether or not that was actually the case in reality. It's just an internal assumption that is made. So even if you ran a payroll on 12/31 and caught off on your income tax for the entire year on that last day of the year, then that will be attributed to the entire year and you won't pay any ounces. And you still have to calculate the number to make sure that's right. But by the end of the year, you already know what that is. It is a way to handle that. It also avoids people having to do manual payment processing, which trips up a lot of people. We charge this year, This year, probably more than any other year, we've heard people having problems with the EFTPS system, which is the electronic funds transfer, electronic funds something, tax payment system. That's what it is. So people have been have got locked out of accounts and were unable to bring up other things. It's been a weird year for EFTPS. If you do it through a W-2, you don't have any of those problems because you get a payroll processor. There's a million of them out there. Gusto and QuickBooks, ADP and Paychex and TriNet and whatever else. Those all will handle those payments on your behalf. And so as long as they do their job, then you're good to go. Yeah, those are all different methods. So method 1, based on last year. Method 2, based on current year. Method 3, don't pay them at all, take the penalty. Method 4, paying through your W-2. So I hope that kind of covers it.
Yeah.
All right. We are coming up on the end here. So that'll be the last question. So the question is, what's next? Or the next question is, what's next? And next is, we've got a 74 days course. So I talked earlier about the 74 days back here, 74 days a year. So the 74 days course is for primarily new, but people who had not done basic tax strategy. There's a suite of strategies that we apply to pretty much every business, and we can achieve massive tax savings with these kinds of strategies. And the 74 days course will take you from, I have this idea for a business, how do I make an LLC, all the way to having a business set up, having these tax strategies in place, and saving yourself giant amounts of tax on the back end. So you can go to taxsherpa.com/74-days, and you could register for the wait list there. Registration's free. The course will have a cost when it's done. I'm still waiting on our production guys to finish up. They keep telling me next week. At this point, we're saying it's coming soon. And when it comes out, you register there, you just put in your email, and then we will let you know when it's available. And we'll take care of you. If you follow along, then you will have yourself a business that is optimized more than 95% of businesses out there, and being able to generate your revenue and keep as much as possible for yourself to grow your business, to support your family, to go on vacation, do all the things you want to do that you have or that you can do with the money that you earn. With that, we'll wrap it up here. And straight at any last words?
And yeah, we can help you navigate your taxes. So it would give you the route to your success. So just give us a call.
All right. So we'll see you all next week. Same time, same place. Tuesday, 6 p.m. Eastern. And we will see what questions we have next week. Talk to you later.